Hello, hi everyone, welcome to Factor Lab. Today is 30th of January 2026 and I'm doing a monthly recap of the month of January. And in this video, I have a lot of interesting data to present. So let's begin. So let's start by looking at the overall numbers at a global level and then at India level. Within India, we'll also see the different sectors. The first thing to notice is that at a multi-asset level, the returns of silver and gold are just tearing apart. In the last 1 month itself, silver has risen by 126% and gold by 36%. And the next comes Hang Seng, which went up by 8%, debt by 1.4%, and Nifty and Nasdaq posted negative minus 1.9 and negative 0.6%. If you put this in comparison against what commodities like silver and gold are doing, you will feel that there is a huge, stark difference between the return profiles of commodities versus the equities. So someone who's positioned or has at least part of their portfolio allocated towards these commodities would have done fairly well as compared to only allocating towards the equities. Now, if you see the market caps within the Indian market, all the market caps, whether it is Nifty 50, Junior 50, Nifty 200 or Nifty 500, have all been in the losses for the last 1 month. Then let's step down and see how did different factors perform. In the factors, you notice that Nifty 50 Value 20 has done phenomenally well. When I say phenomenally well, not as great as what the commodities have done, but at least it has bucked the trend and has delivered a positive 2.6% returns when the overall market was reeling in negative returns. It is worth noting how Nifty 50 Value 20 index is constructed and what are the compositions of it, what goes in this index, and how are they rebalancing. It is worth noting your time and maybe take a look at this index as well. So we have recommended a video on this, so you can search for this video and go through this particular ETFs or index construction. Now let's step in and see how the sectors have fared. Now, as a corollary of the commodities going up, you see the Nifty Metal also doing phenomenally well. In the last 1 month itself, Nifty Metals as an index has risen up by 11.7%. In the entire last 1 year also, you see it has done well, of delivering a 43%, and the last 6 months hands-on returns of 27%. The next index that comes close in terms of performance is the Nifty PSU Bank. The Nifty PSU Banks also have done phenomenally well. We did a very good deep dive in the last month's newsletter where we broke down the fundamental drivers of what is moving the PSU Bank, and you can take a look at that. And in fact, even on the metal sector also, we did a fundamental deep dive and published a research report. I'll be putting that link in our description. Other two notable indices that I want to highlight are, one is Nifty IT, which has done reasonably well in the last 1 month and in the last 6 months, even though the earnings have been poor. This is the dichotomy that I want to cover next in the section. But just note this point that IT, even though the earnings momentum is flat, but the stock is doing decently well, or the sector is doing decently well. And the last sector that I want to focus upon is the realty. Realty sector has taken a very severe beating in the last 1 month, over the last 1 year as well, and it is still continuing to reel under pressure, both technically as well as in the earnings. Also, the realty sector has done pretty bad. So this is about the overall indices. Now let's take a look at the charts. Let's begin by seeing the market caps. Now, if you see the market cap, I'm recording this video as of 12:20 p.m. so you'll still see the tickers moving because this is not the market close. So let's start with the Nifty 50. Nifty 50, when I open the monthly charts, you see that it is still forming the volatility contraction pattern with a small wick on the bottom. Now let's zoom in and see at a weekly level. Now, weekly level is the charts that I usually track upon because this is something that is actionable and also not too short to take a very indecisive call. It is reasonable enough. Now, before I begin and show the charts, I also want to tell you how do I analyze the charts. So if you see, I have an exponential moving average like this, and then which is in dark green, and then you see lines of blue. Now these are of different horizon. Let's say this is of 50 week moving average. It could be 42. It could be 31. This could be 28, etc. So on and so forth. So the reason I have these range of exponential moving averages is that it helps me in two ways. One, it gives me a sense of how the trend is. Let's say you see that all the lines are neatly stacked upon one upon the other. It shows that the market is in a smooth trend, and if it is intertwined like this, then it means that markets are in sideways. And if again the order has been restored, then it is a good sign that a secular upward run or a secular downward run is about to begin. Now this is something that I usually track when I see that whenever a correction is happening, I notice and see if the order is still being maintained. What I mean by order is that all the lines are neatly stacked one above the other. Let's say in the correction that has happened during the month of August, while it did correct, the stacking has been near smooth, or it did not intertwine. It has maintained the order. So this gives me confidence that yes, this is a healthy normal correction, nothing to panic about. The moment I see that these blue colored lines actually coming down one below the other, then it indicates that there is something wrong in the market. Then I see what is the market breadth looking like. That's when I see the market breadth indicator like the net new highs. Net new highs is a concept where we summate the number of stocks which are hitting new highs minus the number of stocks which are hitting new lows. So if the number is positive, it is in green, and if the number is in negative, it is in red. If the number is in negative, it means that there are more stocks which are hitting lows than highs. So that is something to worry. The market breadth is deteriorating. So that's how I usually track the overall indices. Again, I want to zoom out just to share some insights on how I have a sense or how I track the market. So let's go back in time and see how can we use a combination of these net new highs versus the moving averages. Now you see the swaths of extreme green, where a complete greens are there in terms of market breadth and also in terms of moving averages. This is where there is a full-blown market rally across the board. It means all the stocks are doing well, so it doesn't matter where you position, whether it is large cap, mid cap, small cap, you will make money. And in the opposite, let's say if it is a full red, it means everything is falling down. There is no place to hide. It is better to come out and sit aside or take a very small meaningful allocation. Now if it is in between, where there are a lot of overlaps between green, white and red, it means that there is context that needs to be applied. I'll say what context that needs to be applied. Let's say if you're noticing the markets to be rising, but you see the breadth to be overlapping between greens and whites and reds, it means that few stocks are actually rallying, but beneath the index there are many stocks which are correcting. So it is an indication that we need to choose or pick stocks correctly in such markets. And if you see what is happening right now, we are precisely at that phase where there is a lot of switches happening between red, green and white, indicating the markets are pretty volatile, and it is no one stock or no one sector or no particular market cap is doing well. So there's a lot of churning and rotation is happening, and that's also an indication where the active style of picking stocks would do well than being a passive style. Now that is about the Nifty 50 and the market breadth. Now let's take a look at what's happening with the overall sectors. Now let me open the sectors chart. Now in the sectors, I mentioned about metals first. Yes, if you see the metals chart in a weekly time frame, metals are at all-time highs, and metals have already formed a very nice base and have broken out from this base, retested and again and then have rallied. Then you also see the Nifty PSU Bank. In the Nifty PSU Banks also you see a very nice base formation and breakout and continuing in that direction. Now let's see what is happening with other sectors Like I mentioned, two other. One is realty, and then the other is IT. Now, in reality, is in doldrums. It has been in negative decline since at least June of 2024. So we see a correction of 35% since then. So that this is one sector to watch out, where a lot of negative news is happening, because if you see in the fundamental point of view also, that the price stagnation is happening in terms of the new houses that are getting constructed or the houses that are getting sold. The price levels are not falling, but the growth has faltered. The new construction or the sales volume has decreased, both in metros as well as in the tier 2 and tier 3 cities. So the demand is not healthy. Only pocket of console is the luxury and premium segment, where the price as well as demand is continuing to happen. That is what we have seen in the recent Q3 results. Now let me show the other interesting sector where I see that a duality or a dichotomy happening, which is the IT sector. The IT sector, the margins have, the deal flow is continuing to happen in the IT sector, if you see, but the margins are starting to get compressed. Now, when the margins are starting to get compressed because of multitude reasons, the primary reason being the AI, and you see that the IT companies are reducing the headcount or not hiring more, and that is being reflected in its earnings also. Now, what we at least can see is that the bad news has already been baked in, and it shows some kind of bottoming out after a prolonged sideways move since 2021, almost a 5-year prolonged move. This is the first base formation, and then there's a second base formation. So while the earnings have been lackluster, the price is not falling that much as what the earnings results have shown to be. So this is one interesting sector to watch out. And let's move on to the next section, which is about the earnings of Q3. Now we have seen the technicals and the price action of the indices. Now let's take a look at the valuations. If you remember last time, I talked about the valuations being at expensive levels when you compare the CAPE ratios. Now, to justify these valuations, our Indian companies need to increase their earnings. Earnings is a very critical component for the sustained valuations. So as a trigger for the markets to move up, it hinges upon three things. One, the earnings valuation. Second is a budget. What kind of trajectory will the government provide? And third, the India-US FTA or trade deal. Out of these three, the first is already available, which is the earnings season has already kicked in. We have seen a lot of companies publishing their results. So we'll talk about how the results are, what is the kind of impact it has. But before that, I wanted to show you something which is interesting, an analysis that we did on the Indian companies' earnings, their profit margins, and we hit a ceiling wall in terms of profit margins. That is very critical issue to be understood. Our companies, Indian companies, if they have to increase their profits, there are only two ways. One, you increase your sales, or second, if you're unable to increase your sales, at least increase your profit margins. The profit margins that are there in India are at top class levels. So the only option left for Indian companies to do is to increase the revenue. The revenue can be expanded in multiple ways. One, you plow back the profits that you get into R&D or capex, or you start exporting it to different countries. Those are the options that are available from the corporate's point of view. From the government point of view, there are things that a government can do to boost consumption. Those are different aspects which are not part of the scope, but I wanted to highlight that we have hit a ceiling in terms of profit margins, and how do we stand vis-a-vis the other countries. Let me share my screen and show you where do we stand. So as you can see, the Nifty 50 and Nifty 500, their pre-tax profit margins are between 13 to 15%. And if you compare against Germany or UK and Japan, they are in single digits, like 7.7% or 9%. And even if you take the case of USA, we are nowhere less compared to US. We are equally same or similar, in fact higher in terms of profit margins as compared to the US stocks. Now, barring exception that, except for the FANG or the magnificent Seven stocks like the Apple, Nvidia, Google, etc. So if you remove them, even their profit margins are also around 12.2%. What makes the big techs different so that their profit margins are pretty high, like 19.2%, is because their products are IP led, innovation technology led, not a simple commodity or a financials or an FMCG product. Their products like Apple or Amazon or Netflix or Nvidia chips that these magnificent seven companies produce, they are in high demand and are sought after. That gives them the ability to price well. Since they have the pricing ability, they are able to garner a higher profit margins. Now, if you see the share of number of stocks or companies within the S&P 500 which are in this technologically advanced and IP led, they are around 33%. Now, compared to India, it is only 8%. And these 8% again are the regular service based IT companies which are not in the IP based or technology based kind of domains. Now, what is the majority of these stocks that we have in Nifty 500? If you see, these are 40% in financials, and financials is a cyclical sector, not a earth shattering or a rocket science bearing innovation led industry. So if our earnings have to grow, then these companies have to invest in R&D and scale in terms of the innovation. That's something that I wanted to point out. And having said that, now let's take a look at what is happening in terms of valuations. I'll go sector by sector. The IT sector valuations are stable. They are trying their best to reduce the impact of AI by limiting the hiring, and the deal pipeline is good, but the margins are stable, and whatever growth that is coming, it is only because of the margins. Now they have a very critical choice: either they have to plug back this money into building new products, or to acquire new companies which are in the new age technology. That's what is happening in the IT cap space. The FMCG, the demand has been lackluster both in urban as well as in rural setting, and hence the profit margins of the Nestle's or the Unilevers, which are at around 17% and 19%, extraordinarily great. If you compare the parents for the Unilevers and Nestle's, their profit margins are at around 12 and 13%. So there's nothing more that can be pushed on the profit margins side except for the sales growth to come in. And coming back to the sector which is doing good, that is metals. And as you know, metals is a highly deeply cyclical sector. The price is conducive, and also so is the volumes also good in the domestic as well as in the export sector. That's why the metal sector has been able to rally. And a good thing about the other sector, which is PSU Banks, is that there's a lot of cleanup has happened. The credit quality is good, and their profit margins are also pretty good, and hence PSU Banks are again growing. Now, if you see, not as an investor but as a common citizen, you would want your country to have a good breadth of companies, or a good diversification to happen in multiple sectors, so that we are progressing forward and not just stuck in one or two sectors. I think that is there in the kind of breadth that we see in terms of the 500 companies. But if we were to pick, then are we there in the top echelons of innovation led? Yes, maybe not. We are not yet there. I think that's something that needs to be carved out in the coming future years. That's what I hope. Now let's put back the investor's hat and see what can we do here now. The thing that we can do at this point is that we need to position ourselves in those sectors or stocks which are doing well, and be underweight in those sectors or stocks where we see that there is very less growth to happen. That can either happen by actively managing or understanding the sectors, or you can ride the momentum of where is the price momentum or the earnings momentum. Both are equally important are happening. So that's where our strategies come into play. That is the dual momentum and the other strategy, which is adaptive asset allocation. And we are doing an EMA, by the way, tomorrow. So if anyone is interested to join that session, like how are we managing our small case strategy, we'd be happy to welcome and ask any questions that you have related to our strategies. Now, moving forward, as a closing thought, what I want to do is we are having a budget session tomorrow, and post the budget session, we'll be doing a deep dive understanding of what are the hits, misses, actions that an investor can take, and prepare a short summary or a report kind of a thing. And would want to do another video shortly, maybe let's say 3rd of February or 4th of February, and come back with our key takeaways from Factor Lab's point of view, and also possibly do a small write-up on the budget session. Hoping to look forward for a great month next February month, where we would close all the company's quarter results and come up with the next monthly review. Till then, stay safe. Bye.